Thank you, Brett. So Brett is an old friend. He has been a great supporter of all the curiosity that we at Moody's have around digital disruption, and he has been a speaker as well at our conference and coming to see us and keep us in sort of in check of what's happening, what the threats are. But you would say, why rating agencies focused on risk of disruption? Well, we've been very focused. We've written a number of reports because ultimately it's about franchise, and it's about franchise survival or franchise obsoleteness potentially. One of the report, and kind of our thesis, just to bring it out there, is that, and very similar to what we saw from your opinion, is that fintech is a very sexy, hot word out there, but ultimately we're not worried necessarily that the banks will be disrupted by fintechs. And to give you just a little bit of statistics, we wrote a report. One report was about the global investment banks, a portfolio I'm responsible for, which is actually the global GSIBs with significant capital markets operations, including Morgan Stanley and JP Morgan, et cetera. And there, actually, we took the $12 billion number that Jamie Dimon discussed today, and many others brought it in the earlier panels. And if every 14 of these banks that are in the peer group spend 50% of what JP Morgan also is doing in changing the bank of their 25% of pre-tax income, that in the next 5 years, that is going to be $112 billion of ability to actually innovate and change the bank. $112 billion, that's a lot of cash out there. Then we look back, well, how big is the fintech spend the last 5 years? Since kind of fintech was a sexy word, that has been roughly $170 billion. So purely from a number perspectives, the large banking institutions certainly have the capacity to fight with the fintechs. But where in another series of reports we published was really around where the disruption is real from our perspective, and the threat is big tech. And actually, it's very similar to what you also answered. That's one of the challenges. One is, again, will you be able to innovate yourself? Do you have the resources? Do you have the know-how, which was also your choice? And then secondly, if you do, who is the real challenge is potentially big tech. So that's our thesis. We'll kind of try to unbundle with real great experts. Thank you all for being here. Really excited for an amazing panel. We were prepping just before here, and I said this is probably one of the most fun group I've ever interviewed, so thank you for being here. So I'll go with a quote by Governor Carney, who I dearly admire. In 2018, he said, "There's a new economy, new world, and new demographics. Demand a new financial system. The new finance will develop for the new economy, not in isolation from it." So Hugh, you were commissioned by Governor Carney in 2018 to come up with assessment of the UK banking system, and can it actually tackle these problems? And the report is famously called Future of Finance, an amazing report. So maybe just to set the stage, what did you find out, and what are recommendations from you from that report?
Well, Anna, thanks very much. Well, I think to make it short, I won't be able to give you the whole report, but it was a great honour to work for the governor. He asked me to really think about three things. First is, how can technology make the system more resilient? And that was a lot of work around cyber resilience, about the use of reg tech to try and actually get a finger on the pulse of what's really going on. And then obviously thinking as well about the change in business models. What does open banking mean? What does the data economy mean? What does big tech centrists mean? And I think the bank has taken forward an ambition to be a leader in digital regulation. And Tom Mutton, who'll be on a subsequent panel, can give you a bit more flesh on the bones of what that means for the bank. I think second was to think about the big transitions in society. And I think the one to call out is obviously climate change, and how can the bank help shape the standards to make sure that we have the data to make better decisions as investors, as companies, as regulators, and then also then try to embed in risk management climate change for the financial institutions. And that means including stress tests, which will start in 2021. And then the last bit was then thinking about how does finance serve society, and in particular think about payments, about standards, and about the tech stack to support innovation. And I think really the governor's line is really the bank should there be as a platform for innovation. And so we spent a lot of time thinking about what does it mean to have a payment system which is fit for the new digital age? Should the bank level the playing field to allow payment companies direct access, not just the banking payment system, but also to their facilities? And I think there's some very interesting work around that. So it's been a very comprehensive, but I look forward to carrying on this debate with you today.
Great. So I asked, kind of starting first with the banking world, we have great representation from various aspects of obviously the financial services. Open banking. Is it a good word or a bad word for somebody from Santander? And just for benefit of everybody, I asked comes from the tech world, probably a year ago, we joined from Google. So 6 months, actually, less than a year. So it'd be great to kind of reflect on also you coming from the tech world and now being in one of the largest global banks and trying to help them innovate? And what are the impediments of innovation?
So if you look, can you guys hear me?
No. Okay.
Yep.
Yeah.
Yep.
So if you attended Anna's session this morning, you would have heard her talk about PSD2 as one of the first drivers of opening up the bank. And we don't have that here in the US yet. It's on its way here. But if you look at open banking, that's, I think, the key to all of this is going to come down to how do you provide customers access to their data? How can customers trust that the data is being kept safe? And make the customer the center of the, if you look at, let's take transactions from the previous term. Platforms, as you know it, were workhorse systems. SAP platforms, even Google platforms, and anything else that even the banks have built, the core banking systems, if you will, they're all built around transaction systems. The world has changed. We are now talking about customer experiences and delivering delightful experiences. To do that, you absolutely have to make sure that, A, not only is it a level playing field, but that data is now available to everybody, not just from a banking perspective. If I want to deliver value to the customer, I need to know a lot more about them from a 360 view, not just from a banking perspective, but from a telco perspective, from a healthcare perspective. So I think when you broaden that debate, it's not a question of is it important or not. It is. It absolutely is. There's no argument about that. The key is how broadly can you expand it and how quickly can you do it, because at the end of the day, this is going to be about data and trust. Insights on data and trust.
Can I
Please, go ahead.
So one of the, I remember once a comment one of my mentors made is that a lot of businesses think that if you do enough transactions with a customer, you'll build a relationship. And in fact, it should be you build a relationship and invest in the relationship, and then you will do a lot of transactions. So the shift that we're seeing is from this transaction-based world where, hey, if I do business with you enough, sooner or later I know who you are, and then I'll be able to predict how you would respond. We now need to shift to, let's figure out who you are first, and let's figure out, what the customer experience is, and then we will do transactions.
And that's not just with customers. That's the new platform. That's the ecosystem. It's
Partners.
the primary rule of networking. Don't show up when you need something. Provide some value, and then you'll eventually get value back.
Yep.
You drive adoption on the platform, and monetization will follow.
So the big tech has learned how to engage customers. Right. How many billions of users does Facebook have, and Amazon have, and Google have, et cetera? So what the risk of obsoleteness is, and kind of one of the scenarios that we've been writing around, is that they move from that engagement element and to being a distributor of data and services, et cetera, and using broadly data, but actually starting to manufacture products. And it take you not only, so the banks are already manufacturing products that a lot of them are, in a way commoditized. So if it's a commoditized product, and Amazon or Google or Facebook have the engagement with the customer, why they cannot completely make you an obsolete product, or basically you're going to become like the retail store in the corner where you disappear and you're obsolete from just inefficiencies perspective. How are you going to fight with that? Do you have the resources to fight with that?
So if I was a fintech, I'd be worried. Because then I'd be looking to lean on Big Brother, which would be the bigger banks or any other financial institution. But as a large financial institution, we have the capability to also do the same. We have access to a lot of the customer data, actually deeper customer data, I would argue, which can get to the point where I can also get to the propensity to pay, or how solvent a customer is, or how much will they be willing to pay for a service. Which, if you look at the degrees of security on data, at level 2 of Facebook, Google, Amazon, all of them can create data and manage data, but they don't have the depth of the data that I would say banks and previously telcos used to have, right, at the level 3. Level 4 of security is the government, but the government doesn't get into creating products for consumers. And so I would say we have better access and better information on consumers, which it would be great to give that power back to the consumers, have them do the permissioning of where their data is shared, get value out of that, and get value out of the surrounding services. The fact that I can go and create 25 accounts on any of the other players that you mentioned doesn't give me confidence that I actually know who I'm talking to when I'm dealing with them.
So let's move a little bit. We talked about broadly financial system. Now we're talking about insurance. And Timmy, you and I talked about the insurance world needs to kind of wake up. The spend is roughly 1% of revenues versus for tech is 20% of revenues roughly into investment in technology, et cetera. What are the repercussions of that potentially?
I mean, again, I come from the tech industry, and when people ask me why I joined an insurer, I basically made the point that, from my perspective, insurance is now where retail was in 2002. So you go back to that time period, and you had, major, retail chains experimenting. Well, let's say between 2000 and 2002. You had major retail chains experimenting with the internet as a channel of distribution, but it was still kind of an outboard motor sort of thing. You actually had companies that had some, this puts a date on me, but I remember companies having .com teams that were basically a bunch of people in a trailer behind the main building that were playing with the internet while the rest of the company did business as usual. And then within a few years, you saw Amazon gain speed and scale, and fast forward to today, a lot of those retailers are gone, and just a few managed to evolve. The Walmart.coms, for example, managed to evolve, the Sears didn't. Insurance is in the same space, is my belief. And as a highly fragmented industry, even with all the regulation, insurance, essentially a commodity product, some customization, is dealing with digital technology as a major threat from both product creation and distribution. I'm thinking about the point you had made earlier about distribution. I woke up in a cold sweat one night realizing, oh my gosh, if Facebook decides to get into insurance, who are you more likely going to buy an insurance policies from? An insurance agent in one of these little, 4-door offices in a strip mall, or someone you know through your social network. So if someone refers you to an insurance carrier, particularly for property and casualty, I had a bad experience.
Or very, very commoditized products.
Exactly. So we're going to see a massive disruption in insurance. 20 years from now, the players that evolve and survive, there'll be a handful. There'll be some brand new entrants that will come from the proverbial 2 people and a dog in a Stanford garage. And then there will be lateral movement by some of the big techs into the space.
So probably one of the most attractive place where fintechs have been playing is payments. So David, from your perspective, and being senior, management part of Swift, what are the, there's a lot of investment in fintech and payments, various solutions, including blockchain, real-time, transfers, particularly thinking about a corporate role as well. Why Swift wouldn't be disrupted, and kind of how are you addressing that threat from your perspective?
Yeah, it's interesting. I mean, I started in banking 20 years ago, and payments was a real backwater. Nobody wanted to be stuck in the payments department. Now you have investment bankers asking if you're hiring on the payments platforms, right? Because it's kind of the new sexy, and who saw it coming. And I think the reason it is so appealing for new entrants is, one, it's a relatively high margin business, right? And I think they see an opportunity to disrupt because of that high margin aspect. I think, two, the ability to disaggregate certain functions within the payment chain is appealing. So you see people picking off the FX component, right? Or stepping in just for the international payment, or stepping in with very bespoke solutions around invoicing, for instance. So I think all of that where the banks have gotten, had gotten lazy, frankly, right? Because they owned that piece of the puzzle almost in its entirety, allowed for new entrants to enter the space. I will say, though, that we have not stood still. I say we as an industry, and Swift is doing quite a bit, and quite bluntly taking lessons from some of the ideas that have come from some of the fintechs. So GPI, which is our track and trace capability, clearly is coming out of that fintech challenge. We now have 100%, or will have 100% of ubiquity of GPI next year. So that means every payment across the network is fully traceable. I think we are introducing new API protocols to pre-validate the transactional activity before you actually transact. Again, that's coming out of the challenges we've seen from the fintech space, and introducing, all of these premises are built on new API protocols rather than the traditional fin messaging, point-to-point messaging platforms, and we're looking to evolve away from that point-to-point messaging construct. So the industry has not stood still, but I think it's fair to say while the banks were working with the banks to empower them to compete with the fintechs, the big threat or the kind of existential threat had been, I say had, and quite intentionally, the kind of DLT challengers. Frankly, we're not seeing DLT as a wholesale replacement for existing payments infrastructure really taking ground. It doesn't mean it won't, right? But you've seen some challengers step in. Libra's kind of the most, the newest and largest. But until I think, my personal opinion, it's not Swift's opinion, it's Dave Skola's opinion, is until you see a fiat coin issued by a central bank, it's not going to matter, right? Everything else is going to be toying around the edges of kind of P2P payments. And frankly, and I hate to say this in an international forum, but unless it's a US dollar tokenized coin, it really doesn't matter for international trade. Let's be honest, 80% of all trade has one leg in US dollars internationally. So unless the Fed is going to launch a coin anytime soon, which frankly, there's no way, I don't think, I don't think we're going to see a real challenge coming out of the DLT space.
So, talking a little bit about regulation, and you were advisor to Governor Carney. A lot of the banks think, and there was a theme throughout the meetings today, that there is an asymmetric approach of regulation of this activity. Almost the activity got out of ourselves, of the sector, and UK has been the leader in open banking. So why set up open banking that allows for firms who are even more deeply capitalized, some of them, as you said, to be able to use the data without regulating them into the activity they actually perform, which is technically, one can argue, a banking activity. So we heard today from Anna Botin earlier around activity-based regulation. Is regulation lagging, or there is no problem here?
Obviously, I'm going to give a personal answer rather than obviously one on behalf of the bank. So first and foremost, I actually agree 100% with Anna. This is really about a level playing field and having an appropriate level of resilience and security and oversight of the activities of finance, irrespective of whether they're done inside a bank, inside another firm, or wherever. And so actually, it's really about a level playing field. And so the work that I did for the bank, let's say around payments, the Bank of England is going to be taking forward an initiative to consider whether payment firms should have direct access to not only the payment systems, but also the balance sheet of the bank. In that case, the basis for that was to level the playing field. Now, the quid pro quo, so the response of that will be they will then have to jump to a very high standard to have that access, and it will be no different from a bank. So let's be clear, the work I was involved in, it was about a level playing field. When you talk about the challenges of open banking, there are two, and more broadly about GDPR, PSD2, there are a couple of challenges here. First is, they're out of date. So PSD2 was written a decade ago. Payments is moving so fast, as we've said on this panel. It's hopelessly out of date already, and it wasn't thinking through some of the issues which we all know in the room are live. So So point one is regulators need to be somewhat agile. They're never going to be first, but they need to respond in a pragmatic and fact-based way to what's moving on. Number two, open banking was set up really as an antitrust response to banking concentration. And because it was done as an antitrust piece of legislation, it's got some issues. And it probably is not as fully founded. And then third is, and I was chatting with a governor of another central bank yesterday, if you go first, there's always going to be some teething issues. It's a bit like if you're driving in the snow. If you're the second or third car, you know where to drive. But if you're the first car on the snow, there's some challenges. So guess what? Open banking has got some flaws. But the good news is the bank is being very thoughtful about its role in this. But let's be clear, it's not the primary regulator, because it was started as an antitrust piece of legislation. There's many other actors. And so I think it has an important voice to call out where there are issues. One that I spent a lot of time thinking about, and I think it's something which underlies both our panel and also the panel before, is resilience and what happens when things go wrong. And I think it's really important that the liability, if stuff goes wrong, who is on the hook? And I think this is where I think, again, I agree 100% with Anna. That's an area where we probably need to refine. But, Rome was not built in a day. There are some teething issues which I'm sure will get worked through over the coming years.
So let's talk about what can go wrong. And we're talking about data and accessibility to data. Who does the customer trust in a new world? What I'm hearing is, in a lot of the thesis, that, well, would you rather trust Facebook or an incumbent fintech element with potentially KYC issues, et cetera, or you would trust Santander with all the regulation and know your customer and compliance investments they've done. But is this the only barriers to entry you have towards the fintech?
So I'd like to take a slightly different
please.
spin on that, but first let me be on record. I also agree 100% with Anna. But to answer your question, actually, maybe I go back to sort of the principles I'm setting up for the platform. And we'll take your international payments case, disaggregation of payments. Customers have found value in that slice that international payments has offered them in that journey. What they've done as a result of that, willingly or unwillingly, or wittingly or unwittingly, is given up their data. There's no protection for them when they now have signed up for a new service, not knowing how that data is going to be used. So what we are proposing, sort of the principles I'm setting up for the platform and for Santander as well, is what we're calling the power of and. Right? So deliver both the things, don't make the compromise. Deliver the fabulous journey, the delightful journey that the customer needs, without them having to give up their data. Right? So the best way to understand the power of and I'll take a non-financial example. Growing up, they always told me that you can either have a fast car or you can have a fuel-efficient car. You can't have both. Well, guess what happened? Somebody changed all that, right? And now we have Teslas, which broke that entire. The whole idea is the platform principles are based on no compromises. With the same situation, I will look at data, right? Being able to provide the data insights and be able to do intelligent operations at the same time at scale. So I think data from that perspective is very critical. We've talked about symmetry. We've talked about all. The regulation must catch up. It's far behind. But one of these things that, while it's waiting to catch up, the lessons we have learned from the fintechs, and we have learned the lesson, right? I mean, they've shown us a gap that exists that we need to fix. And I think that's where the path we are on, whether we do it by acquiring, partnering, or building it on our own.
So with data, it comes about using that data in cloud computing. Yeah. And we've had some, as you know, very public issues, Capital One, and gets to security and cyber risk. And is cloud computing, even with all that that happened this year in the news, is basically the way to go? Is there a choice outside of cloud computing in the new world? And why we should be? Is there another choice? Or people are like retrenching, or this is the future? And are we talking about 100% cloud computing? Are we talking about confidential customer relationships versus not? How is the financial sector thinking about this?
I don't think anyone on this panel will say there's a 100% cutover.
No.
Yep.
I think.
No,
all got enough gray. And
but
go ahead.
I do think there's an inevitable progression towards cloud computing for almost every aspect of a client's back office, of a business's back office, and it's simply a cost-benefit play, right? I mean, Siri's weighing in. That there's no way that any one company, even the J.P. Morgans of this world, right, can invest to the same scale that AWS or Microsoft Azure or you name that public cloud provider can invest in security and in scalability. So I think, and we're already seeing those institutions start to leverage the public cloud. We've already been deploying, what was unthinkable years ago the Swift interface, right, the gateway into the walled city of Swift. We're now deploying it in the cloud as well with our clients. So I think it is inevitable. There's the concern around the jurisdiction in which those clouds reside is becoming more and more of a concern, right? Particularly, we heard it, I think, on a couple of the panels this morning. You know, if there are only US-based cloud providers out there, and concerns around, you know, geopolitical fractures continue to emerge, then that's I think going to be a concern. But otherwise, I think the progression from on-prem to cloud is inevitable for almost, you know.
So Hugh, you spend a lot of time in the report on cloud as well. Maybe share some thoughts there.
Yeah, so look, I agree with this. I think that the trend to cloud is strong. We had McKinsey to help us with some estimates. They were estimating potentially between 50% and 90% of activities could either be on cloud or software as a service in the next decade. So that's the trend. So what are the issues? So first and foremost, can I take a slightly broader issue about how does the banking system evolve with technology? And I think one of the most telling things to me is that the marginal cost of producing a financial product is basically zero. And obviously there's a regulatory stack, there's a due diligence stack, but the marginal cost is close to zero. Look at this, in the last 2 weeks, we've seen Fidelity and Schwab move to zero cost equity trading. Over the last decade, the cost of an ETF for a main indice has fallen by about 90%. So in this business where the margins are ever finer, how do you respond? Well, you need to probably respond with scale. So the top players can invest for clients, can invest for security. But what do you do if you're a mid-sized player with an old tech stack? You know, you're squeezed because you've got the new firms with a fresh tech stack, and you've got the scaled firms. And so I also thought, you know, when I was trying to think about the financial system of the future, resilience isn't just about today, it's about the forward.
Yep.
And so I was thinking, well, what's going to happen to the mid-sized banks? Either they will need to roll up and have, you know, M&A, or they need to be able to benefit from other people's scale. And if we worry, we don't want monoculture. We want a diverse banking system, insurance system. So actually allowing them to use APIs, use cloud, use machine learning, use the best tools. And the other thing, of course, is if you're on a cloud platform, you can work with a whole bunch of fintechs and borrow the best brains from entrepreneurial houses. So I think there's actually a very strong sort of like societal case, in a way, you know, to allow firms to use cloud and other, you know, sets of technologies. So the challenge then is, what is the right governance framework? What is the right oversight? And what's the right controls? And I think there is a sort of geopolitical challenge here. If you're sitting in Europe, and your banking system is backed up either over here or in China, that's a challenge. So the localization of data and the jurisdiction, I think, is going to become probably one of the hottest topics. And that's something which I'm sure more work will be done on. But making sure that financial regulators can get, you know, oversight, and I think under the, you know, under Frank Dodd you clearly do in the States, I think is a key issue for regulators.
I mean, we already have the largest M&A in the U.S. banking sector, you know, BB&T and SunTrust, which was the CEOs basically very bluntly said this is about technology play, et cetera, and they're the $250, $400 billion bank. They're not even the small banks, and they're saying the danger is here. But one of the questions, just to kind of bring the audience in the picture, and thank you very much for the questions, is banks may have the firepower to spend on tech, but isn't the challenge that they get nowhere near the ROI on tech spend that big tech does, given the amount that goes to legacy? And actually, I'll bring that, whoever asked that question, is that David Pinta said this morning about the $12 billion, again, the famous that JP Morgan is spending, is that is 50% as effective as the one on Amazon that Amazon spends because of legacy issues. So I think that, so what is the solution?
I think it's a very valid point, but you have to look under the spend to see how much of that is being spent to innovate on new things versus to keep the lights on.
Yeah.
Right? That these numbers are good numbers to have at the broad scale, but when you look under the covers, what are we spending to come up with new revenue curves? The existing product curve, if it's slowing down, how do you build in new revenue curves? And what is the spend on that? I think that's where it's key. And banks do have the firepower to spend on that. It's never about the spending. It's about having the right business model and then backing it up with the technology. I think the other problem we have is everybody thinks technology first. I'll say a point that I think you sort of mentioned it, but it was embedded, so I'm sort of going to bring it out. The move to cloud is inevitable, but it has to be done in such a way. We've done this so many times. We better learn and learn fast that if we don't do it right, we're building the next legacy.
Yes.
You have to build it in such a way that
it's
no
for the
matter
future.
what changes after that, you are able to bring that
Yeah,
in.
it's not just lift and shift, right? You have to put
right.
new
Invest it.
So getting to the spend thing, I think it's also important to recognize where we are when people talk about the amount of investment and the spend by the fintechs. Is to realize where we are in the bull market cycle, right? So we're at the top of the market when capital is relatively available for emerging companies, or as my grandfather, who was a farmer, would say, in a tornado, even turkeys can fly. So we're at that part of the market. When the market changes, I've seen a couple of these venture capital-based cycles. When the market changes, there won't be as much capital available for the raw fintechs. They will need to look for a place to go. They will need to look for platforms that they themselves can reside on.
Right.
And I think the spend equation, regardless of the capital efficiency of the spend, the numbers will change. And I think we should expect that the numbers will change, and we will see that the incumbents will still have pretty hefty wallets because they have real balance sheets, and a lot of the emerging companies will, they will be in a starvation scenario.
Well, just to bring that, in one of the reports we published, we had a statistic from the European Banking Authority that more than half of the spend of the European banks specifically is actually for defensive purposes and not for investment. And it goes to the same point that the person who asked the question is, if you're only doing it for defensive purposes, just catching up, and you're not doing it to innovate, it's obviously going to catch up with you. But I have a great question on insurance topic, actually, as a matter of fact, from the audience. And this is about what are the most significant features of a technology stack in the insurance company of the future?
I think it's actually customer experience. I think the insurance industry is this multi-hundred-year-old. Essentially modern insurance as we know it evolved from a bunch of guys sitting around a coffee house in Holland, basically shaking hands before they sent ships abroad to find tulips and beans, and a lot of the infrastructure is essentially a descendant of those early conversations where things were ultimately inscribed on paper. They get a nice little, you get an insurance policy, you write a bunch of things down, you put a little nice green ribbon on it, you stick it in a safe, and you never see it again, right? So the customer experience is really, really bad. And I think the most important part of the stack in insurance is actually going to be the outer part of the stack, the customer experience side. And I've said internally within Transamerica, we need to invest in design. We need to think about, it was may have gone unnoticed, but one of the newest general partners at Kleiner Perkins a few years ago was John Maeda, who was a former designer from the Rhode Island School of Design. They actually made him a general partner in a venture firm. So they would look at every new investment through the lens of someone who could see customer experience first and not look at the infrastructure underneath. So I would say that's actually number one. And second to that would be openness, and actually building a true open architecture, and not an open architecture along the lines of an open data architecture, because we're going to have to interoperate. The insurer of the future is not going to sell policies. They're essentially going to sell risk management at the consumer level. And so therefore, they're going to need to have open architecture to interact with different sorts of speeds and feeds and different data sources.
So bringing a little bit to the payment side, and know your customer issues, AML issues, how much of that is an issue for Swift to be basically, still a leader, i.e., you already have those things established. Maybe the startups don't have that. And is this how you think about that as from defense model, at least for the Swift business?
Yeah, there was the quote given at the start of, or right before the panel started around, will the innovators get distribution before the distributors get innovation, right? And I think, Swift, we have 11,000 endpoints, right? 11,000 banks on the network, 2,500 corporates. There's nobody who even approaches that really in the competing space, with the possible exception of the card networks. So that is clearly an advantage. It's not something we can rest on, however. So I think in terms of what do we need to do, and this goes back to the overarching theme of the the panel is, as a platform, we need to be able to provide more ready access to the platform and the services that we offer, right? And that's been a big part of our API drive and creating hooks into the platform for multiple providers to then offer services on top of what we do. Because we have a kind of champagne problem at Swift in that we have more opportunity to get into things than we can possibly address.
Yeah.
Everybody wants Swift. Why doesn't Swift do this? Why doesn't Swift do that? And there's no way as a 3,000 person not-for-profit consortium-run business we're going to be able to address all those. And we've rapidly come to the conclusion that in order to address that, the entirety of that client demand, we have to leverage other firms working off the back of the platform and the data that we provide. So I think that is how we compete, right? It's not through trying to do it all ourselves. It's by empowering partners and our community to build off the back of the platform.
And in terms of, has Swift done any investments in, the blockchain startups or experimented with that? You have your own Silicon Valley team, like all the other banks. Like,
no, we definitely. I mean, we view blockchain DLT as a tool in the toolbox, right? And there are appropriate uses for it. We've found it a pretty compelling proposition in some of the security space in the around corporate actions and the tracking votes and just making sure that the immutable aspect of a blockchain is very compelling in that regard. When you're processing $1 trillion an hour or whatever in terms of transactions, it's not such a compelling proposition, right? And especially when the banks want a trusted central counterparty, they don't want an open architecture blockchain.
Not a public blockchain, but there are enough structures that exist today that actually can be used instead.
There are, and we are looking at so in the security space, we've seen more of a buy-in in blockchain, right? So in Australia, ASX has recently put in a fully blockchain-enabled platform. We're now getting requests from clients for us to potentially host a node for them, right? Because the clients are already starting to see, well, if Australia does it and Switzerland's lined up next to do it and Hong Kong's after that, and I'm going to be running 40 different nodes, that's not scalable for me, right? Is there a central counterparty who can host those things? So we're looking at that as well. But I think we will not, have not, and won't look at blockchain for the sake of just saying we've done a blockchain proof of concept, right?
So mixing it up a little bit, I have a great question from the audience. And Hugh, maybe you can start on this one, but please everybody pitch in afterwards. Most successful platforms take on a loss leader strategy for an extended duration to gain absolute scale. Do financial institutions' shareholders have the sufficient level of patience to warrant successful execution of a platform strategy? And this goes back to the CEOs before saying, like, oh, would I like not to report every quarter? But that's no choice.
I think that this is a great question, whoever asked it, because I think there's actually a couple of different areas that I've spent time thinking about. So let's be first. The attackers have got a kind of a winner-takes-most attitude and are being funded for minimum 5 years, not without profitability, and in some cases spending a serious amount of money. I mean, not WeWork money, but but a sensible number of billions. And I think there's some interesting issues here. It is a winner-takes-most. Actually, as a financial regulator, most of these companies are kind of irritants rather than big disruptors. But still, if they had a million clients, and then the VCs just say, you know what, we're going to fold this, it's not worth the effort. That's kind of an interesting conduct issue, at least for those million clients. So point one, what happens if a VC pulls the plug on a bank or a payment firm which doesn't really work? I think that's actually genuinely interesting. Number two, where I did spend an awful lot of time and effort, and actually probably an area of controversy in us unpicking this issue, was what does this mean for the banks of the future to invest? And I was obsessed, like all of us I think are on the panel, about not just running the lights on, but the change the bank, and then within the change the bank, what proportion of the budget was on innovation. And my kind of rule of thumb was if you're a top 3, top 5 bank, you probably can do it. But beyond that, how do you invest? And I think particularly in Europe where negative rates are insidious and are hurting, damaging the profitability, and this low rate experiment has been tough. Take the Eurozone. Eurozone banks are making 4% ROE. Where on earth is the budget to do this? And so I do worry that the intersection of low rates with tech is quite a difficult one. And I think stateside, it's a very different equation than you are on the territories with negative rates. So I think it's a great question. I don't think there's any one answer, because I think it depends country by country, segment by segment, and again, who responds, who's the leader. Right.
Yes.
Based on sort of some of the things I've done in the past and sort of I look at platforms as not, the problem is everybody starts with technology and then says, what ROI can this technology do? You have to come up with, the first thing you have to actually think through is the business model. Even before you start thinking about the how, right? And in your business model, typically if you're doing a platform where you want externals, which is where you will really going to start making the money, you have to, just a mental model is, for the first 3 years, just think of adoption. Set the stage internally to say you're not going to get any revenue from this for the next 3 years. It's a tough move because you have to convince everybody internally. Done this in the past where we said we wouldn't make any money and made 40 million in the first year and 100 million in the second year, but it was enough to buy napkins for the company I used to work for, but it proved a point, and it proved that there is money and there is a model to be made.
I mean, look at Goldman Sachs investing now in obviously these different startups and Apple Card, et cetera, and the number of questions on any earnings calls announcement are disproportionately focused on that versus the rest of the business. So almost like you're almost not allowed by the shareholders to invest because of the pressure of they want delivery immediately.
And the second piece in that, in those 3 years, you have to work really hard to find the ecosystem that will make money off your platform. So when people talk about monetization, it's not yours, it's theirs, because they're giving you their time and their effort to build on your platform or integrate with your platform. If you can find ways for them to make money, your platform sticks and you're golden.
I'll give you a best example of that I know is a company called Viva, that some of you may know, which is basically a cloud-based CRM for the pharma environment. And they decided they were going to build a application from scratch for the pharma food chain. They did not write their platform. They just used Salesforce. And they basically put their entire value into, all of their value is basically from on top of the Salesforce platform. So now, the last time I checked, they only raised roughly $6 million to start the company. And last time I checked, the market cap was about $19 billion.
Wow.
So one of the highest returns on invested capital around there in the venture world, because they essentially found the right platform where they could scale. And those are the types of stories that both a platform builder would want to create and a new application generator should seek out.
So value for the full chain.
Yeah, and that, I mean, not to make this a swift pitch, right? But we have the benefit of not being a publicly traded company, right? That's owned by the banks. So it is exactly, we have that kind of, the opportunity to be the Salesforce of the banks without having to demonstrate that quarter-on-quarter return. I think it's just a matter of, again, creating the capacity and scale for the banks to build on top of us in that way.
So unfortunately, I have a signal tells me we're done with time. I can go forever with your amazing panel, and thank you so much for your time, and thanks for the audience for sticking here in Friday late afternoon. Thank you.
Thank you so much.